It does feel like we're near the top for interest rates, I have to say, thank goodness. And I'm wondering, what are your thoughts on this? And could this make a difference for smaller companies? Ken, I'm going to kick off with you.
Sure, thank you. So first thing I'd say is that we try to be relatively agnostic in our investment approach to big macro factors like interest rates. Now, that's not to say that we aren't affected by them, but we're trying to always build portfolios of companies that can thrive and can deliver value, even regardless of the kind of external environment. So whether the economy is growing and what rates are doing, or other big macro sort of factors that affect sentiment and other parts of the economy. Having said that, clearly the major change in the rates environment over having been very benign for 15 years has changed the dynamic in terms of how particularly these longer duration and kind of higher growth stocks have been valued. But because we're very focused on valuation, there's a lot of the companies that have been derated really materially were valuations we just wouldn't have invested in them before. So because they didn't meet our criteria. So actually, sort of slightly counterintuitively, the changing rate environment and that derating has put a lot of high quality growth companies back into our sort of area where we actually might back them. And so there's lots of businesses we've tracked for years where they've just been too expensive, and now they're not. So that's been good from our point.
Really great that it's actually great. Well, I mean, I can't say it's really great because it's been very, very tough, but it is good that you're seeing those opportunities for those companies that you've wanted to, buy for a long time. That's really encouraging. Amanda, how about you? What's your view on the way forward for interest rates and how that could make a difference for smaller companies?
Yeah, similarly to Ken, we don't take macro bets. We buy high quality companies that can perform in all environments. And this is what's happened. We've had some great companies within the trust, and they have performed really, really well. But against a backdrop which is dominated by inflation, a style has been out of favor. And all the good performance and resilient earnings that our companies have delivered really haven't been rewarded in terms of share price. Now, I think we can all agree that after last week, we've probably reached peak interest rates, and the direction of travel is to the downside from here. And that's really what we've needed for our style. For quality growth, we've really needed to break that inflation spell. And I think we can all agree that the future certainly looks better for the past, for the path of interest rates. And that's great for smaller companies. It's great for quality growth. And it's also great for sentiment. It improves consumer confidence. And that takes us away from all of the cost of living crisis that has been so dominant for so long.
Absolutely. And Jules, what's your view on rates and the impact this could have?
Yeah, so we think there's quite a sensible 4-point checklist for getting more constructive on equities in general in a bear market. The first is actually peak interest rate and inflation expectations rather than actually the point where they peak. So I think you can go back to the summer and you can see that the market was expecting the bank rate to get up to 6.25%, 6.5%, and inflation on a 3-year view to be 6.2%. So we're well past that now. We've clearly at 5.25% on the bank rate, and it looks like it might be stable there for some time. The second is trough valuations. The UK market, UK small cap market's very cheap. So I think we can put a tick next to the first two. The third is very negative positioning and sentiment, and I think we would all agree that the positioning and sentiment towards UK small caps is extremely negative. So we're pretty sure we've got that one as well. The fourth is the rate of economic deterioration. So you want the rate of the economy slowing to start to improve. It doesn't need to flip positive, but it can't be getting worse more quickly if that makes sense. And I think we definitely had that from November through to June or July this year. We were outperforming on GDP. The UK was one of the most upgraded economies from a GDP perspective. I think part of that was expectations were extremely negative around October, November last year. More recently, PMIs have rolled. So perhaps waiting for those to trough would put a proper tick next to the last of those points. But it certainly feels like those set up a great period of outperformance for smaller companies.